Hello and welcome to Portfolio Matters week 113. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult professional investment advisors before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. A reminder that I am in Crete again this week and we'll have a slightly foreshortened show. Next week, normal service should resume with Richard, I hope. Okay, not much news last week. We had, though, two important pieces of information. So we had last Friday US non-farm payrolls data, and they met expectations and showed that job creation slowed from February to March, but that the labor market in the US remains very tight and unemployment remains at its low of 3.5%. So far, the Fed has failed to create any slack in the US labor market. So there was nothing in the jobs report to prevent the Fed from raising again in its May meeting. US inflation numbers were out and they were slightly better than expected, but core CPI rose again last month to 5.6%. We'll go through the data in a minute. US producer price inflation also beat expectations and by quite a margin. So this is current market expectations for Fed policy rates, and it's expecting that the Fed will hike again in May and then start to cut in July. Okay, this week's economic data. In the UK, we had the British Retail Consortium's retail sales year on year for March, and that was good. That beat expectations and was at 4.9%, same as February, but higher than expectations. Expectations had been for a fall. We also had the British Bankers Association mortgage rate, and that rose much more than expected, rising to 7.22% in March, well up from February and well above expectations. So that is further indications that banks are raising interest rates and reducing credit, and that is very bad for the housing market. We also had GDP numbers for February, and they came in slightly worse than expectations on a monthly basis. So month-on-month GDP was expected at 0.1%, came in at 0%, well down on January, but then it beat on a year-on-year basis. It was expected at 0.3% and came in at 0.5%. I'm not sure how you reconcile the miss on the monthly and the beat on the year-on-year. It implies that economists don't know what they're doing. We also had a load of data for February. Please pause and take a look. I'm not going to go through it because I think that everything has changed after the banking crisis in the US. And as we go through this, you'll see that in the last couple of weeks, there has been a substantial contraction in credit, which I think changes everything. So I think the data for February is increasingly irrelevant. What matters is how the current credit crunch affects data going forward, particularly from April onwards, this month onwards. So in the US, we had the non-farm payrolls, starting with the unemployment rate, which met expectations at 3.5%. So down on February, the US labor market remains very tight. Non-farm payrolls came in at 236,000 jobs created in March, and that was pretty much bang on expectations, but well down on February. So job creation is slowing. The participation rate beat expectations, coming in at 62.6, and that is good news. More people are going back to work in the US. Hourly earnings met expectations, And year on year came in at 4.2%, slightly down on expectations and down on February. So wage growth is slowing, but slowing slowly and remains well above the Fed's 2% inflation target. We also had US inflation numbers, and the headline number was better than expected, coming in at 5% year on year against expectations of 5.2% and well down on 6% in February. Core CPI, though, met expectations, rising to 5.6% in March from 5.5% in February. So core CPI, which the Fed is more interested in, continues to be persistent and elevated. Producer price inflation beat expectations. Year on year, it came in at 2.7%, below expectations and well down on February when it was 4.9%. US core producer prices also beat expectations and were well down on February. Okay, on to some charts. So this is UK retail sales, which beat expectations and show actually pretty decent growth year on year in nominal terms. This is the UK British Bankers Association mortgage rate, which continues to rise, and that is very bad news for the UK housing market. UK home affordability continues to deteriorate. UK GDP going nowhere, but at least positive. A UK construction output, we have data to February, and that shows surprising resilience. It bounced back in February from January, but you'd expect rising interest rates and reduction in credit to cause a slowdown in construction everywhere, including the UK, over the coming months. UK industrial output year on year remains negative, but does not appear to be deteriorating further. Industrial output month on month fell by 0.2% in February. In the EU, in February, retail sales fell 0.8%, not great. Year on year, they were down 3%. Now, moving on to the US, we had month on month CPI inflation, and that came in at only plus 0.1%, below expectations, mainly due to falling energy prices. And year on year, inflation also came down sharply, beating expectations. And despite all the fears about persistent inflation, if you look at the graph, that seems to be quite a rapid fall. However, if you then look at core CPI, that is not falling. And we will go into more detail on the causes for the continued strength of core CPI later on. Producer price inflation fell sharply when it's down 0.5% month on month, beating expectations. And year on year, again, fell very sharply. Core producer price inflation also fell month on month, and again, very sharply year on year. The unemployment rate fell back to 3.5% in March, and the labor market in the US remains very tight. Non-farm payrolls showed that the US continued to create jobs last month, but the rate has fallen. So signs of weakening in the labor market. The participation rate ticked up. Hourly earnings ticked up again, 0.3% month on month. But on a year-on-year basis, they are declining. So signs that the labor market is slowly easing and wage growth easing with it. Manufacturing payrolls month on month in March fell, but not by very much. All the indications are that US companies are hoarding labor. So breaking down the jobs numbers, the private payrolls have shown a distinct slowdown over the last 3 months. Now, the US government is running up against its debt ceiling, so it can't issue more debt. So it is running itself by paying down its cash balance with the Fed, the TGA account. So it is short of money. And normally when it's short of money, it tries to cut costs and therefore cut jobs. But that hasn't happened so far. That can't continue unless the US government comes to an agreement to raise the debt ceiling. US average hours worked fell, and that is back towards its pre-pandemic norms. So further signs that the US labor market is weakening. Used car prices rose month on month and year on year are back towards flat. US consumer credit in February rose slightly, and year on year that looks like quite normal. Retail sales year on year, and these are nominal numbers, faded again. So further signs of weakness for the US consumer. The 30-year mortgage rate fell, but remains very elevated compared to 2 years ago. And the mortgage index actually rose slightly, but remains very subdued. So not much mortgage activity in the US. Initial jobless claims ticked up, but not by a substantial margin. And continuing jobless claims actually ticked down. But initial jobless claims data has been revised higher for the past few months. So the red line is the revised data. The tan line was the original data. So the revisions show more jobless claims than previously reported. Okay, so in summary, February data shows that the UK and EU economies were performing better than expected. EU industrial production surprisingly rose 1.5% month on month in February, showing that as the energy crisis in Europe has faded, so European industrial production has bounced back. In the US, non-farm payrolls were in line with expectation, but showed a significant drop in hiring in March. But the labor market remains tight and unemployment was back at its cyclical lows of 3.5%. The Fed has so far failed to create any slack in the labor market, but there are definite signs that the labor market is weakening. CPI fell more than expected to 5% year on year, but core CPI rose to 5.6%. Core CPI is being kept high by the lags inherent in owner equivalent rents. We'll go through that in a minute. Okay, so we have reported that PPI fell more than expected. It is commonly believed, including by me, that PPI leads CPI, so that sharp falls in PPI now should lead to further falls in CPI in the future. Now, so what is the difference between PPI and CPI? Well, CPI calculates the inflation rate paid by residents of urban areas and is based on their consumption patterns. It includes the prices of imported goods. PPI calculates the inflation rate paid by producers on their inputs. Now, because the input inflation experienced by producers is passed on to consumers when producers finish producing their goods, it is commonly believed that PPI leads CPI. So producers will pass on the inflation they pay to consumers with a lag. So PPI is expected to lead CPI, but is that true? Challenging my own prejudices, the answer is no, not really. They tend to move contemporaneously, and that kind of makes sense because they're based on the same data sets. What is true is that PPI is much more volatile than CPI. So in summary, PPI does not lead CPI. They tend to move together. And therefore, the recent sharp fall in PPI does not necessarily portend further sharp falls in CPI. Something to bear in mind. Okay, onto one chart. Well, this is the Fed's remittances to the US Treasury, and these are cumulative since September 2022, when I presume it went negative. And as you can see, QE did not save the US government money. It merely shifted interest payments forward in time. So previously, because the Fed had bought loads of treasuries from the government, it was receiving interest payments and was returning those interest payments to the US Treasury. Now, as it's raised interest rates, it has lost money on those treasury bills that it bought during QE at much lower interest rates, and is also paying out to banks via the reverse repo facility at much higher interest rates. And so it's losing money, and these are its cumulative losses. I think history will judge QE to have been a very ill-judged policy. Okay, now moving on. We're going to, the big question for me at the moment is the behavior of banks. Since the failure of Silicon Valley Bank, we have seen big withdrawals from the US banking system to money market funds, amongst other things. Now, before I do a special section on the banks, I just wanted to briefly go through how banks create deposits. So deposits are created by the banking system itself. When a bank makes a loan or purchases security, it creates money. It doesn't need existing deposits to make that loan or purchase a security. It simply credits the seller's account with money. So it creates money by itself, but its ability to create money is heavily regulated and constrained by its profitability, liquidity, and capital costs. So the important ratios are its liquidity coverage ratio. It should have high quality liquid assets to cover a minimum of 30 days expected outflows from the bank. Also needs to have capital equivalent to at least 8% of its risk-weighted assets. And since the GFC, the supplementary leverage ratio means that banks should hold at least 3% Tier 1 capital for their unweighted loan book and 5% for globally systemically important banks. So banks create money by themselves, but their ability to do so is regulated. Until the GFC, so you're looking at the period prior to 2008, you'll see that the deposits at US commercial banks, which is the red line, closely followed loans and leases. So as banks created loans, they also created deposits. But since then, the two lines have diverged, and that's because the other entity that can create deposits is the Fed. So when the Fed does QE, so it purchases an asset from a non-bank investor, it creates a deposit at the Fed account of the investor's commercial bank. The commercial bank then deposits that money in the investor's bank account. So QE creates deposits. And so since the GFC, you've seen that total bank deposits are highly correlated with the Fed balance sheet. Why does this all matter? Well, US commercial banks have seen significant withdrawals in recent weeks. And withdrawals from small banks have been particularly noticeable, although there was a small inflow last week. And a lot of that has been due to withdrawals to money market funds. But part of the drop in deposits is because banks have been selling securities such as mortgage-backed securities. Now, when a bank sells an asset, the purchaser pays the bank back with money it has on deposit, and therefore deposits fall. So prior to this transaction, the bank had an asset and a liability in the form of deposit which it owed to its counterparty. After the transaction, the counterparty has the asset and the deposit has disappeared. So selling securities reduces deposits at the bank, and banks have been dumping mortgage-backed securities in record volumes, and that is bad for mortgage-backed security prices and hence for mortgage rates. Money creation in the modern economy is mainly done by banks, and actually banks don't need deposits to make loans. They can just create money out of thin air, subject to certain regulatory requirements. And the recent fall in deposits in the US banking system is not all due to depositors taking out their money. It's also due to banks deleveraging. And so on to bank credit. Now, last week, we saw that there was deposit flight from the US banking system, and that was leading to a reduction in loan growth. Now, this is really important, and to me, it is the most important thing going on in the world economy right now. If there is a credit crunch with banks around the world reducing credit provision, then the modern economy is highly financialized and very dependent on the constant flow of credit. Essentially, all large purchases are now done with credit. If credit stops or slows, then the economy has to slow. So the question then becomes, have the outflows we saw in the US continued, and has the credit crunch that we saw and reported last week continued? So these are deposit flows from the US banks, and you'll see in small banks, deposit outflows actually stopped last week, but deposit outflows continued from the large banks. However, all this data was reported on a Friday, and the latest data will be reported later today. In the US, the deposit outflows now mean that the regional banks have fewer deposits than they have hard to sell investments. So their net liquidity position is extremely poor, and they have had to turn to the Fed for replacement funding, and that replacement funding comes at a significant cost. So deposits costs the bank 0.5% on average, but the funding from the bank term lending facility comes at overnight interest rates plus 10 basis points. So that currently is about 4.9%. So borrowing from the Fed is very expensive and reduces bank profitability. So small banks in the US won't be able to make profitable loans and increase their loan books unless they find an alternative cheap form of funding. Another headwind for the banks is that the Biden administration is proposing to reverse a 2018 change in regulation that reduced the oversight of small banks, and that will further constrain their ability to make loans. Now, much of the money flowing out of the US banks is flowing into higher yielding money market funds, and that can be expected to continue when the average rate on a US deposit account is about 0.5%, but you can get 4.75% on a money market fund. And the speed of outflows from the banking system to money market funds has been unprecedented compared to previous Fed cycles. And that could well be the impact of technology, where you can move funds at the click of a mouse. Now, something I was unaware of, and thank you to Discord member Wayne J for pointing this out, is that in the US, there is a way to avoid the $250,000 guarantee on deposits with domestic banks by putting the money into a brokered deposit account. And the broker deposit account then spreads the money between lots of banks in $250,000 chunks. So in aggregate, a larger sum is fully covered by the $250,000 guarantee limit. And so what's happening is that you're having outflows from small individual banks into brokered deposits, and that money is then spread throughout the whole banking system. As deposits have left the US banking system, so the banks have increasingly turned to the Fed for replacement liquidity. But as we've discussed, that is expensive and reduces profitability, and hence the bank's ability or inclination to make loans. And the big question was whether deposit outflows would lead to a reduction in credit, and the answer is yes, it is. So for the second week in a row, we've seen a decline in bank credit, and actually week on week, last week was worse than the previous week. And these are loans and leases, weekly data, falling, week on week, loans and leases, negative. In order for the loans and leases balance to actually fall negative, you need borrowers to have made more repayments to the banking system than the banking system has paid out in new loans. And so you're seeing a net contraction overall in credit. The fall in bank credit over the past 2 weeks has been very large by historic standards in nominal terms, but as a percentage of total assets, it is of a similar magnitude to previous episodes of credit tightening, such as the GFC. This is small bank loans and leases. Again, sharp drops. So we have monthly data for real estate loans, and data is for March, last report on the 7th of April. And as of that point, it was still growing, although it had slowed significantly since January, which was an extraordinary month. But if we look at the weekly data, it shows that small banks have cut their real estate loans in the last couple of weeks. So when we get the next monthly data, it should show a fall in real estate loans from small banks. Other data confirm that the banks are cutting back on their loans to the property sector. And the commercial property sector is not doing well. So there's lots of similar stories on Twitter, but this is an office block. It was a Class A office block in California bought by Blackstone in 2014. And now, 9 years later, it's been sold at a 36% discount to its original purchase price. We're expecting a bad year for commercial real estate, where lots of loans taken out during the good times when interest rates were much lower need to be refinanced, at much higher interest rates, and some of those loans will default and banks will need to absorb their share of the losses. As bank lending contracts, these are the sectors that will be most affected, and real estate is the worst. And it's not just in the US. European banks are also rapidly tightening their lending standards. So in summary, this is, I think, the most important data to be watching at the moment. We've seen a sharp contraction in bank credit over the last couple of weeks. And if that continues, then I think a recession in the second half becomes absolutely inevitable. All large construction projects and investments rely on credit provision. And as that slows, then so new projects are cancelled or delayed and a recession becomes inevitable. Okay, on to Inflation Watch. So we had data for the US. As reported, CPI came in at 5.0%, down from 6% in February, so rapid fall. And core CPI actually rose month on month to 5.6% from 5.5% in February. Now, this is CPI in the US, and you'll see that energy inflation dropped a lot and did good inflation, but services inflation remains strong and continues to rise. But CPI seems to be following the pattern of previous inflationary episodes and looks increasingly transient. So last week we reported the ISM Services Survey, and their price index leads CPI by 3 months, and it is continuing to fall, and therefore we should expect CPI to continue to fall. And the same is true for core CPI. Now, the reason core CPI services is elevated is because 55% of it is owner equivalent rents, and as we've reported many times before, owner equivalent rents has large lags in it. So it will remain elevated for some time, despite rents in the real world falling. But owner equivalent rents are correlated with the house prices, and house prices are falling. And so owner equivalent rents should soon begin to fall. If you exclude rents, core services inflation has been declining, but the 3-month annualized number, which is the light brown lines, have not been falling and actually rose last month. So it shows that core CPI, excluding rents, is sticky. And that is unsurprising because it's highly correlated with wages, and wages are showing persistent strength on the back of a tight labor market. So the bottom line is, if the Fed wants to get services inflation down, it needs to reduce wages, and therefore it needs to create some slack in the labor market. And this is a summary of the situation for core CPI. We're seeing big falls in core goods inflation, which is now running at 1.6% per annum. And excluding rents, services inflation is coming down slightly from its peak, but rents continue to rise and are dragging the whole line up. Pictet Asset Management are forecasting that core CPI falls to 3.6% by the end of the year. But the money supply is falling, is declining at quite a sharp rate, actually 7.5% per annum. So if inflation is a monetary phenomenon, then you expect inflation to be falling quite sharply. And we know that goods inflation is falling, and the global container freight index is now 87% below its pandemic peak and at its pre-pandemic levels. Now, some of the good news this week was that we saw a rise in the participation rate. And actually, if you look at prime age employment in the US, it's actually above pre-pandemic levels, which means that some of the fears about long COVID and a permanent reduction in the healthy workforce have not become true. And that's very good news. Now, the UN Food Price Index continues to fall. And last week we were talking about high European food inflation. Well, in the US, food prices are starting to fall. You would hope that in Europe, food prices also fall in the coming months. In Europe, electricity prices are actually back to their pre-war levels, which is also very good news for inflation and for the economy. So in summary, inflation is slowing, but core inflation in the US remains persistently high, in part due to the lags in owner equivalent rent. But even excluding rents, core services inflation remains persistently high because wage inflation is high. And if the Fed wants to get that back down towards 2%, it's going to have to create some slack in the economy. Okay, onto recession watch. So recessions tend to follow Fed hiking cycles with a lag. The gray vertical bars are recessions, and you'll see that whenever the Fed has raised rates very sharply, as it has now, then a recession tends to follow. And that is particularly true when the hiking cycle has been rapid, and this cycle has been very rapid, and the yield curve has become inverted, and both of those are currently true. So history would suggest that a recession is highly likely later in the year. US real interest rates are rising fast as inflation falls and the Fed continues to raise interest rates. Based on the Fed's own projections and the likely path of inflation, real interest rates are forecast to go strongly positive, i.e. towards 2% in the coming months. Now, turning to credit conditions, the Senior Loan Officer Survey all show tightening lending conditions, and that tends to lead GDP by 2 quarters, and so should lead to falls in GDP. GDP is the light blue line and is inverted. And tightening loan standards also tend to lead default rates. And we know that there are a lot of zombie companies in the US that were kept alive by pandemic fiscal and monetary largesse. And as interest rates rise and credit conditions tighten, they are likely to get into difficulties. A further symptom of the banks reining in lending is they are increasing their financing rates, and this is finance rate on new cars, and that's risen sharply, and credit card rates are their highest in 25 years. All of that means that consumers will be spending more on financing, and that will detract from demand. If you look at the credit impulse, which is defined as the change in bank credit, it is falling fast, and the same in Europe. And money supply growth in Europe is very negative. And if we now turn to the Citigroup US Economic Surprise Index, well, it has been positive in recent weeks and is now fading. The number of US temporary workers is now in decline, and that is a leading indicator because the easiest workers to fire are temps, and so that tends to lead employment. And if we look at the Challenger job cut numbers, which we reported last week, this shows which industries have been cutting employees, and unsurprisingly, technology is the largest sector. But what I found interesting was that construction is still gaining jobs. The ISM new orders minus inventories looks increasingly poor, and that looks very much like a recession is coming. So I thought this was really interesting. This is the US retailer Costco's gasoline sales, and you'll see that they have been declining, and that is a really good real-world indicator of declining economic activity, people moving around less. And if we look at rail traffic in the US, and that is the light blue line, you'll see that it is lower than it has been in recent years, but is showing little sign of deterioration. In the UK, landlords are increasingly struggling to collect their rent, and by the end of March had collected only 63% of rents owed, and that is substantially below the pre-pandemic level of 75%. So in summary, Deutsche Bank thinks there's now over a 90% chance of a recession. Andreas Steno Larsen's macro model also shows the increasing chance of recession. Bottom line for me is that credit conditions are tightening fast, and unless that changes, a recession becomes inevitable with a lag. So if we now turn to the unanswered questions about the world economy and fill in some of the data we have seen this week, has unemployment started to rise? Well, job creation in March slowed from February but remained positive, and unemployment fell to its cyclical low of 3.5%, indicating the labour market remains tight. So the labour market is slowing, but slowing slowly from very high levels. The only data we had on construction activity was for the UK, which showed a strong bounce in the UK in February. Now, the big question was about the banking system, and last week's data were not reassuring. Deposit flight continued from the banking system as a whole, although not from the smaller banks where it stabilized, and there was a net small inflow, but loan growth definitely continued to fall. More data is out today. So although the inflation numbers we saw were reassuring at a headline level, core CPI rose last month, and there was nothing in the US inflation report to prevent the Fed from raising again in May. Okay, on to other charts. Well, this week, the IMF released its long-term growth forecast for the world economy, and they were increasingly pessimistic. So they think the growth rate of the world economy is in decline to around 3% per annum in the medium term. This chart shows the banks that hedge funds are most short of. So the banks they think are most likely to get into difficulty. So and number one is TD Bank in Canada, followed by BNP Paribas. The market seems very concerned about Canadian banks, where there's been an enormous property bubble. And when I am back next week, I will aim to do something on global property markets. The chart bottom left shows the premium that developers need to pay above interest rates in order to secure funding for property development, and that premium has risen from practically nothing in 2022 to almost 5%. So buy-to-rent development has become increasingly unaffordable. So around 20% of companies listed in the US do not make enough money to cover their interest rate costs, and that is only going to get worse as the economy slows and interest rates remain high and banks cut down on their lending. So expect some highly indebted and unprofitable companies listed in the US to go bust in the coming year. So after all that, you need some good news. And there is some good news in the form of lung cancer death rates in the US and by extrapolation everywhere in the developed world, where governments have intervened in the market to increase taxes and ban smoking on planes and restaurants. And that has all resulted in a fall in cigarette consumption. And with it, lung cancer rates have fallen precipitously. So sometimes the government needs to act to save people from themselves. And onto equities, where generally it was a good week. So the all share was up 1.2%, stocks Europe up 1.1%, S&P up 1%, NASDAQ up 0.6%, and it's up 16% on the year. Hang Seng up 0.5%, Topics up 2.7%. Bitcoin had an amazing week, up 9.9% and up 86% on the year. Sterling and euro both strengthened against the dollar, and the dollar index fell by 1%. VIX continued to fall as the S&P rose. Sometimes the equity market is difficult to interpret. It seems that the market is seeing the fall in inflation and expecting equities to benefit as interest rates don't rise as high as previously anticipated. But the equity market seems to be ignoring the fact that the underlying economy is slowing. And over the next few weeks, we will get Q1 earnings reports in the US. And we'll see whether the recent rises in equities are sustainable. This is the S&P 500. Retail investors have this reflexive urge to buy stocks that have fallen a long way. So they have piled into the banking stocks that have fallen the most. And reminder, bottom fishing in the banking sector is unwise because their balance sheets are incredibly opaque. You don't know what they're exposed to. And if you'd done that in the GFC, you would have suffered. So be warned. So the recent rise in the S&P 500 has made me look again at the relationship between liquidity, which is the blue line, and the S&P 500, which is the red line. And it seems to hold. We have had a rise in financial sector liquidity over the last few weeks as the balance sheet of the Fed has risen because of special lending to the US banks. But the Fed's balance sheet has started to fall again. And the Treasury General account is almost exhausted. So the Treasury General account can't fall much further, and the Fed is starting to reduce its balance sheet again. All of that suggests that liquidity will fall in the coming weeks. If the correlation between liquidity and the S&P 500 falls, that should be bad for the S&P 500. This chart, pause, take a look, shows the performance of the S&P 500, that's in green, during and after recessions. And generally, the start of recession is very bad for equities, although it is not always, that is not always the case. But pause, take a look. Thank you to Spider786 for sending that. This is performance of the S&P 500 around the time of the Fed's first rate cut. Now, what it shows is the S&P 500 tends to fall sharply after the first Fed rate cut, and the Fed is still raising rates, and we may be some months from the first Fed rate cut. But the Fed cuts rates in response to a slowing economy, which is bad for equities. So be warned. And this earnings cycle is officially over. S&P earnings are negative year on year, and history is any guide, they're likely to keep on falling. And onto commodities and energy commodities. Well, oil had another good week after the OPEC plus cuts last week. Brent rose 1.3%, WTI rose 2.2%. Natural gas continued to drift off everywhere, and that's good news for inflation and the economy. Dutch natural gas futures are now down 45% year to date. UK natural gas futures fell 3.8% on the week and down 44% year to date. US natural gas futures continue to drift off, down 55% year to date. Coal, having bounced with oil last week, fell 3.5% and is down 51% year to date. Uranium's flat. Some numbers specific to the oil market. Well, all change. We had a rise in oil inventories in the US of 6.8 million barrels, including the SPR, and 8.4 million excluding the SPR. So there was a release from the SPR, but even excluding that, there was a build in inventories. And that is bearish for the oil price. US crude production ticked up to its recent highs of 12.3 million barrels, but it is only up 300,000 barrels on the year, and the Baker Hughes rig count was flat. This is Brent. The bear case for oil is that we are going to transition rapidly to electric vehicles, and that demand will collapse, but there's very little evidence of that. If you look at Q1 sales of cars in the US, only 4.3% of new cars were electric vehicles. 95.7% of cars were internal combustion engine vehicles. So it seems that we're going to need oil for a long time yet. This is the change in crude production for some major producers over the last 6 months. And you'll see that Saudi Arabia and the UAE have cut output, but actually some other big producers have increased output substantially, in particular Nigeria. And on to industrial commodities, where it was a mixed week. Aluminium rose 1%. Copper had a good week, up 3.5% and now up 9% year to date. Chromium down slightly. Iron ore fell 1.2%. Lithium carbonate continued to collapse, down 6.9% on the week, 62% year to date in the first quarter. Neodymium down further 6.6%, down 33% year to date. Nickel bounced up 4.7% on the week, but down 21% year to date. Tin down 1.9% on the week. Further, vanadium down 1.1%. Zinc up. So quite mixed. Some of the industrial commodities, such as copper and aluminium, up on the week, but the battery metals continuing to fall. This is copper, which actually rising back towards its recent highs. And if we look at the overall CapEx cycle, then CapEx has not recovered this cycle, and that is very favorable for commodities in the medium term. There is a lack of new projects coming on stream. Turning to precious metals, well, it was a great week. Gold up 1.6%, silver up 4%, platinum up 4.6%. Rhodium is the exception, falling 4.5%, down almost 40% year to date. Palladium also joined in, up 3.2%. Going through some graphs. This is gold. That looks good. That looks like a new bull market. Silver following gold up, and so silver increasingly looking like a monetary metal rather than an industrial metal. Platinum bouncing, Rhodium, very much an industrial metal and drifting off. Palladium, fairly flattish. Is that a bottom? And on to rates. Well, it was a surprisingly poor week in rates, given that inflation came in below expectations, and we have lots of indications of a fall in bank credit, which will lead to a slowing economy, which can be expected to lead to falling interest rates and a recession. So we had a rise across the curve. The UK 1 year rose by 19 basis points, the 50 year by 16 basis points. In the Eurozone, we also had rises across the curve. So concluding comments. Well, inflation is steadily falling, but core inflation remains persistent. And although the labor market in the US is slowing, it remains tight, and wage inflation remains well above the Fed's 2% target. The market is pricing in a 75% chance that the Fed will raise rates again by 25 basis points at their next meeting in May. But to me, the most important data we're seeing at the moment is in bank credit. Banks are seeing outflows and they are reducing credit availability. And if that continues, then to me, a recession becomes inevitable. And finally, on to me and my portfolio. Well, I had an absolutely terrible week, down 2.9% as long bond rates rose and long bond prices fell. Now, I'm actually increasingly confident that we're going to have a recession and that will lead to a fall in inflation and falling interest rates. And so I'm actually quite relaxed about that performance. I think that bond yields will fall in the second half, and I actually added to my trade this week by buying some more long-dated UK government bonds. But that performance put me down relative to the all-share of 4.1% on the week, and I'm now down on the year and massively underperforming the all-share. And this is the cause of all the problems. This is the 2068 index-linked gilt, and you'll see that having had a good few weeks, it has drifted off again. As a recession approaches, I expect interest rates come down and the 2068 gilts do quite well, but I've been expecting that for a while and have been wrong. And in the short term, anything could happen. Okay, that's it. Thank you all for watching. Next week, I am back, and hopefully Rich and I will be back to our usual schedule. In the meantime, thank you for watching. Please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.